Good morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda. Stocks bounce back with Asian equities gaining after their worst day on record. But China vows, quote, to fight to the end after President Trump threatens additional levies of 50%. The White House rejects a tariff pause as the Treasury Secretary signals a priority for Japan in trade talks. Billionaire Ken Griffin calls tariffs a huge mistake that will hurt the US middle class. Plus, the EU weighs 25% retaliatory levies on some US goods, but spares American whiskey as the bloc seeks negotiations. Good morning, happy Tuesday. European futures then pointing to gains of 2%. Is this a dead cat bounce or is this the markets finding something of a flaw? We did again yesterday in the US session see the Trump tariff chaos continue to cartwheel through these markets. FTSE 100 futures now pointing to gains of 2%. US futures on the S&P E-minis after an extremely volatile day on Monday currently pointing to very modest gains in the context of the losses that we've seen, with the S&P still close to that bear market of around 20% from its previous high, currently pointing to gains of around 1.2%. Nasdaq 100 futures looking to add 208 points. Again, to what extent can this be sustained unless and until we get clarity from President Trump? Let's flip the board and have a look cross-asset, because the other feature of the market moves yesterday, alongside the volatility and the intraday moves in the equity markets, was a pronounced sell-off in the debt markets. US Treasuries, and you saw 10-year yields up 19 basis points. Currently on 2-year, 372. You're seeing moves of 4 basis points. So a bit of reprieve in terms of selling pressure today. Yields down 4 basis points. But again, in the context of the sell-off that we saw yesterday, euro dollar currently bid up 0.6% at 109. Brent also gaining, given the squeeze that we've seen on oil prices. Currently $65 a barrel on Brent. And gold gaining for the first time in 4 days, up 0.6% on the yellow metal. Let's quickly have a look at the Asian market, where the focus is on Japan, given the reportings that that country is front in the line to have these negotiations with the Trump administration. The Nikkei then rallying strong in the session today, rallying hard, up 5.5%, but given the losses of yesterday, again, on the expectations that maybe there's some resolution on the trade front between these two nations. Broadly across the MSCI Asia Pacific Index, given the rout that we saw yesterday, historic in its size and scale, currently up 2%. HSI over in Hong Kong gaining 1.5%. And again, the focus on the Nikkei and the gains coming through there. The Japanese yen currently at 147. Let's get more details in terms of what is happening across the Asian markets and more broadly as well. And bringing Bloomberg M-Line strategist Mark Cranfield joining me out of Singapore. Mark, Asian stocks then gaining today. Is there a sense that this can be sustained?
Well, it's a bit of a turnaround Tuesday, as you were saying there, but the conviction levels don't seem to be very high. If you look at the trading volumes, are not that great. And if you look at Japan is doing slightly better, of course. It looks as though they're in the driving seat. They're possibly going to get a deal earlier with Donald Trump. But as you were saying earlier, China seems to be taking a much harder line. And that's reflected in what we're seeing in Hong Kong and Chinese equities today, although there are official support measures going on by the Chinese authorities. We've seen the PBOC announced earlier today it was going to provide more money for the ETF funds, which go directly into the market on behalf of the Chinese government. So that is happening. But still, people are very, very cautious. As you say, we've seen some extraordinary moves, particularly over the past 3 trading sessions. And well, the rebounds today are nowhere near enough to put people on the situation to say, yes, this is a very strong rebound. We're very bullish now about the market. People are really holding back, and they're looking ahead. It was going to be a very difficult week. The mixed messages are coming out, whether or not there are going to be any concessions or not, whether there's any room for people to negotiate properly on this. And all in all, it's telling you that nobody here in Asia especially is really ready to say, OK, that's it. Market is turning for the better. And of course, the big absence is movements from central banks. People are looking back to 2020 when the pandemic started, markets cratered, but central banks came in very quickly to provide high liquidity and to stimulate markets. That is not happening this time around. The Federal Reserve is noticeably taking a very cautious approach, and other global central banks are looking to them for leadership. That is not happening at the moment. The Federal Reserve is more interested in inflation concerns, and that is filtering through to financial markets. So for the time being, yes, we're seeing a reasonable amount of green. We are not seeing a high conviction that people think this is the turnaround that's going to set us back on a bull market.
OK, no high conviction, and we wait to see if the central banks are pulled from the sideline. As you say, to what extent could China look to the yuan, the currency, as a pressure valve as President Trump threatens additional 50% tariffs? So you're looking at 104% just in this current presidential term, of course, on Chinese goods. Is the yuan a pressure valve that China may reach for?
That certainly appears to be the signalling which is coming out from the central bank in China. Use this daily fixing to send their messaging to traders how they want them to perform in the yuan market. And it's been very clear over the past 3 days, they've been moving that fixing towards a weaker currency. And then they're allowing their onshore currency to go a little bit weaker at the beginning, but then pull it back. So it's very clear that they're showing the world, we can move this currency if we need to. We can move it in a direction which compensates for some of the tariffs we're expecting to see happen. It's very similar to 2018, 2019, when, as Donald Trump put tariffs during his first term, as the tariffs came on China, the yuan currency moved almost exactly in line with the degree to which the tariffs were being imposed on China. If there's anything like that this time, the yuan will weaken significantly, even though it's already relatively weak compared to the US dollar now. It looks as though it's very much a messaging that China is saying, look, we could make it much tougher for you by weakening our currency a long way. We're not doing it yet, but we're showing you we have the capability to do it. It's a bit of a cat and mouse game, but traders can see very clearly what is going on here. And at the moment, we're pretty close to the thresholds that would bring in a lot of people to say the yuan is becoming a bit of a one-sided view.
OK, China arguably heating up that currency threat as it looks to the response, of course, from the Trump administration. Mark Cranfield with a breakdown as to what we're seeing across these markets and the context. Mark, thank you. Let's get more details then and bring in our correspondent on what is happening with China. The response there seems to be pretty firm then. China criticising the US for threatening to hike tariffs further and pledging to retaliate if Washington follows through. In a statement, the Chinese Ministry of Commerce said Beijing is prepared to, quote, fight to the end. Let's bring in Bloomberg's China correspondent Min Min Lo in Hong Kong. Min Min, what have we been hearing from Chinese officials? What is their level of determination not to back down at this point?
Yeah, it's quite clear. We heard from the Chinese Commerce Ministry this morning. They are planning to fight to the end. We are less than 24 hours from the deadline of that ultimatum passing. Trump saying he will impose an additional 50% levies on Chinese goods if China doesn't remove those retaliatory tariffs. And it doesn't look like that is going to happen. But the other key message from the Commerce Ministry, though, is they are still calling for dialogue. They're not closing the door there, but they're at the same time also not knocking down the door to get to the negotiation table with the US as well. They're pretty patient here, and that is what one Chinese expert that Bloomberg has interviewed has mentioned, that China believes that at some point the momentum from Trump's effort is going to start to fizzle out, especially given he is facing pushback domestically as well. The White House having to issue a veto threat when the Senate is pushing through this bipartisan bill that could limit his ability to impose tariffs. So for now, they're in this hunker down and fight mode, because yesterday President Xi was quoted in the state TV broadcast last night saying, calling on the country to unleash the full potential of China's consumption in order to spur the economy. We are seeing all these state media lines calling for extraordinary measures to support the economy, to stabilize the stock market. So the attention is now focused inwards to really ring fence the economy from the external tariff shocks.
Yeah, and on a number of metrics, China is better positioned to fight back this time around in the latest round of this trade war. Min Min Lo, thank you very much indeed with the latest in terms of China's response to these additional threatened tariffs from the Trump administration, joining us out of Hong Kong. Let's get more on what we've been hearing then from President Donald Trump, saying he is not considering a pause on his plan to implement sweeping additional tariffs on dozens of countries tomorrow, while still signalling he could be open to some negotiations. He was asked about a potential pause in the Oval Office yesterday.
Would you be open to a pause in tariffs to allow for negotiations?
Well, we're not
looking at that. We have many countries that are coming to negotiate deals with us, and they're going to be fair deals. And in certain cases, they're going to be paying substantial tariffs.
Okay, for more, let's bring in Bloomberg's Kriti Gupta. And Kriti, the president yesterday in the Oval Office then with the Prime Minister of Israel, Netanyahu, who is, of course, a strong ally, a very close ally of the US. And Netanyahu had said, look, we're going to reduce tariffs, we're going to reduce surplus. And yet Trump did not commit to reducing tariffs on Israel. What does that tell us about where this president stands right now, given the market pressure?
Well, Benjamin Netanyahu's visit to the White House was very much a litmus test for every other nation in the world who, to your point, is looking to negotiate some sort of relief from these tariffs. But the fact that he isn't willing to budge, especially with the likes of Israel, is quite crucial here, because not only is Israel an economic partner that does have a trade deficit with, that, of course, he is willing to bring down some of those barriers, as you mentioned. They also have a kind of political alliance, a geopolitical alliance as well. So there is a question here of why not be more lenient with Netanyahu in that environment, and yet he won't budge. And the logic is twofold here. One, because there is still some kind of leverage and negotiations to be done. At least that's the claim that the White House is making. The other piece, remember, he has talked about how tariff revenue is meant to be funding tax cuts for the American people. Tax cuts, by the way, that a lot of Republicans and a lot of Americans are expecting to show up in the back half of this year. He's also looking for that tariff revenue to help close the deficit in some way. Whether the math actually adds up is a completely different story, but simply to kind of have some fund flow in that direction is one element that's driving the Trump administration to not only create individual tariffs to bring down the tariff barriers, but to create that universal kind of tariff of 10%.
Well, on the question of income and flows of capital, there's some reporting suggesting from our own team, of course, in Washington, that the Trump administration could be considering some tax credits for US exporters. Where do those discussions lie? What does it tell us about thinking within the U.S. administration?
Well, it's just an idea at the moment. It hasn't fully germinated into an execution or even something that would get perhaps the blessing of Congress, which is what it would need to actually be enforced here. This is crucial because Donald Trump's tariff plan is ultimately to help create a manufacturing hub in the United States. The United States is a service-oriented economy. We haven't been a manufacturing-oriented economy since, I think, the late 1800s or the early 1900s, if you will. So there is a move here to kind of create that manufacturing center. But in the process of doing that, one, there is a big labor shortage that happens in the manufacturing sector. The United States does not have enough skilled workers at the moment to create that giant hub that he's looking for. It's also going to cost them initially. And you're already seeing that in things like producer data, factory data, et cetera. You're already seeing a lot of those costs pull forward. So this tax credit, in theory, would basically help offset some of those pressures that the manufacturers are facing if you export to another country that has reciprocal tariffs on the United States. That's the thinking there. Is it enough to still incentivize it? Because at the end of the day, like we just mentioned, the point of these tariffs is to increase revenue. A tax credit like this would decrease it.
Yeah, and one wonders if importers in the US might put their hands up and say, hang on, we could do with some support as well, given the higher costs that we're going to have to consume and take on board as a result of these tariffs. Kriti Gupta, opening trade anchor, thank you very much indeed for breaking all of that down for us. Let's get back to the market implications then of all the latest we've been hearing on the tariff front. Frankly, the chaos and confusion in terms of the lines we're getting. Peter Navarro saying that tariffs are not a negotiation. Scott Bessent, the Treasury Secretary, saying they could be a negotiation. What is going on? The stock market rout, of course, turned into a bond market rout yesterday. That was pronounced with global long-end yields surging. Bloomberg's Valerie Teitel is here to break that story down for us. Val, what was happening in the bond market yesterday?
A lot of market participants scratching their head over what drove this incredible weakness we saw in the long end of the Treasury market. Those 30-year yields rising 20 basis points on the session, Tom. Is this about potentially de-risking of bank balance sheets, a scramble for liquidity, and they're selling Treasuries in order to raise that cash? Is it perhaps about deficit concerns heading into an economic slowdown with an already bloated debt-to-GDP ratio in the Western world? Or thirdly, Tom, is it about the fact that the U.S. is alienating some of its major buyers of Treasuries, be it China, Japan, the U.K., and Canada, all major buyers of Treasuries that continually are being alienated by the U.S. government with this tariff fight? I, for one, was very impressed to see that this backup in yields has totally erased the April 2nd rally in the long end and in the 10-year yields. We've now erased that massive rally we saw after April 2nd, trading unchanged, virtually unchanged in over 5 days' time. But this move was not just in the Treasury market, Tom. It was also global. Take a look at what happened in the long end gilts. 30-year yields rising some 20 basis points on the session. And intraday yesterday, they actually had one of the worst moves since the Liz Truss era of October 2022. European bonds suffered as well. France long end up 8 basis points, and Japan in the Asia session rising 17 basis points. So this is a really global jitter when it comes to the long end of the Treasury curve. I want to also note, Tom, though, we have had more Fed speakers of late, which could also be adding it to this mix. A lot of them warning on inflation. The one from Goolsbee stood out very much to me. He's known as the key dove at the Federal Reserve, and he was talking about this tit-for-tat tariff retaliation might send us back to the kind of conditions we saw in 21 and 22 when inflation was raging out of control. That is a big warning from one of the chief doves at the Federal Reserve.
That is stark, isn't it? And so no doubt, as you say, bond traders will be weighing all of this up in the session today as well. Yields a little softer in the session today, just down 4 basis points on the US 10-year. But of course, that sell-off pronounced yesterday. Valerie Teitel breaking down the moves in the bond markets for us. Thank you. Coming up, the European Union signals its readiness to use a range of countermeasures with Trump's additional tariffs, of course, set to come into force tomorrow. We are live in Brussels with the latest. That's coming up. This is Bloomberg. Welcome back. European Union trade ministers have closed ranks and signalled readiness to deploy a full spectrum of countermeasures, including potential taxes on digital companies in response to President Trump's tariffs. Let's get more then with Bloomberg's Oliver Crook, who's in Brussels, was covering this for us yesterday at that meeting in Luxembourg. Ollie, was there a breakthrough then yesterday in those EU talks? How aligned are EU trade ministers right now on this issue of a response?
So as you mentioned, Tom, really the ambition was to close ranks, to really sort of have any sort of daylight be sort of squeezed out between these different trade ministers in terms of their approach on how to respond to the United States. So we should say there were really 3 goals in the meeting yesterday. The first was to hammer out the details of the sort of reciprocal, or I should say the retaliatory tariffs just on the aluminum and steel. We can get into that in just a moment. The other was to basically sort of hammer out also negotiating positions in terms of what they're willing to give to the United States in the eventual possibility of a negotiation. This is, of course, the number one option that is preferred by basically everybody in Europe. And the third, the so-called Plan B, which is what was also discussed, is what are you going to do if the Trump administration is, as Peter Navarro sort of seems to be suggesting in the pages of the FT overnight, not really open to negotiation, but really just sort of in it for the long haul in terms of the trade war. This is something that I spoke to a number of different trade ministers about yesterday, including the French trade minister. Have a listen to what he had to say yesterday in Luxembourg.
Everything is possible. Everything is possible. We have a wide toolbox, and everything is possible. And at the end of the day, we don't want to use it, but we can use it. And this is, I think, what was most consensual.
And so the everything and the everything is possible. This talks about targeting American tech companies. This is talking about potentially taxing services. This is, of course, also talking about the ACI. This is an acronym we all need to get used to, the anti-coercion instrument, the EU sort of nuclear option in terms of trade policy to really be able to lash out against nations that they consider are basically forcing them into coercion. But what I was really struck by, Tom, I think above all, was just basically how clueless they are into what is in the mind of Donald Trump and what it is that the administration actually wants from the Europeans. There has not been a high level of contact. Everybody there wants to de-escalate the situation. De-escalation was the word, but at the end of the day, they're starting to have to be more and more realistic, and again, to not be naive about what the Trump administration's ambitions truly are.
Yeah, and they're not alone, of course, in not knowing what is in the mind of President Trump. It seems some of his advisors don't know what is in the president's minds, given the mixed messages we have been getting from them. Is the EU, though, you talk about the measures that they have up their sleeves. It seems like, according to reporting, they are looking to drop one measure, which is targeting US whiskey. Why is that?
Yeah, so bourbon was one of the things that sort of dropped off of the list. I think that part of the reason there is you're going to have some pressure from a number of different countries within Europe in order to not get into retaliation in terms of the spirits industry, so of course the wine and champagne. This is, of course, Tom, something that Trump has threatened to put 200% tariffs on in case there is retaliation from the Europeans in terms of what they do to the United States. There's also potentially a generous view of basically how, like for like, the United States is thinking about these sort of tariffs. But what we should say is we do have the list, and we should say, Tom, this is retaliation not for the 20% that are coming in tomorrow. This is for the steel and aluminum tariffs. So what is on that list is diamonds, motorcycles, boats, household appliances, safety glasses, playing cards, tobacco, some agricultural product. Most of those are going to face a 25% tariff. Some of them are going to face about 10%. Those would come into effect April the 15th. They would not start collecting those duties, though, until May because they want to give themselves as much runway to negotiate with the Trump administration if they're willing to do so. Again, the big question for all of these European policymakers is Trump willing to negotiate?
Okay, and that's quite the spectrum, isn't it? From US playing cards to US diamonds. All right, Bloomberg's Oliver Crook, thank you very much indeed. And the latest in terms of how the EU is looking potentially to retaliate. Coming up, we're going to continue the conversation on the EU's tariff response. The president of the European Confederation of Independent Winegrowers joining us shortly for an exclusive interview. To what extent will there be relief that there is no 50% tariff on US whiskey given the threat to the winemakers of Europe? That's coming up. This is Bloomberg. Let's get you up to speed with other news making the headlines today. In terms of what should be on your agenda, President Trump ordering another review of the potential sale of US steel to Nippon Steel. US steel shares surged as much as 15% after the announcement, triggering circuit breakers and halting trading briefly. Shares closed higher in New York, though still well below Nippon Steel's $55 a share offer. The order gives new hope for the deal that was scrapped by then-President Biden over national security concerns. And President Trump says the US is holding direct talks with Iran on its nuclear program, with the next round taking place on Saturday. He made the comments during talks with Israel's Prime Minister. Officials in Tehran say they've sent a proposal for indirect talks in Oman instead. Trump has said he wanted direct talks to replace a nuclear deal that he abandoned during his first term in office. And Samsung shares jumped after its preliminary first quarter profit beat expectations. Strong sales of its Galaxy S25 smartphone and legacy DRAM chips ease concerns about the tech giant's ability to weather both US tariffs and chip export curbs. But Samsung faces challenges with catching up to rival SK Hynix in the lucrative market of chips enabling AI accelerators. And Apple is said to be planning to send more iPhones to the US from India to offset the high cost of China tariffs. According to the Wall Street Journal, the adjustments are a short-term stopgap while Apple attempts to win an exemption from President Trump's tariffs. Trump's tariff package raises levies on Chinese goods to at least 54%, while imposing a 26% rate on Indian goods. And Bloomberg has learned that Shein's plans to shift some production out of China are being met with opposition from Beijing. We're told the Commerce Ministry is discouraging the fast fashion giant and other companies from diversifying supply chains by sourcing from other countries. Shein is also facing the end of US tariff exceptions for small parcels, a change due in less than a month. Coming up, Wall Street titans speak out against Donald Trump's tariffs. We're going to have the details, bring you some of their comments and whether or not this raises additional pressure on the Trump administration. That's coming up. This is Bloomberg. Good morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda. Stocks bounce back with Asian equities gaining after their worst day on record. But China vows to, quote, fight to the end after President Trump threatens additional levies of 50%. The White House rejects a tariff pause as the Treasury Secretary signals a priority for Japan in trade talks. Billionaire Ken Griffin calls tariffs a huge mistake that will hurt the middle class. Plus, the EU weighs 25% retaliatory levies on some US goods, but spares American whiskey as the bloc seeks negotiations. Let's bring you a check of the futures picture then. And it is a brighter start to the session than we've seen, of course, since April the 2nd and the unveiling of those Trump tariffs. But no doubt the Trump tariff chaos remains front and centre for these markets. Are we finding a floor now for the markets, or is this a brief stay of execution? European futures pointing to gains of 2%. FTSE 100 futures looking to add 155 points. S&P futures, after some huge intraday swings yesterday, looking to gain a little over 1% in the session today, still of course, close to that bear market territory. Nasdaq 100 futures already in a bear market, looking to add 0.9%. Let's flip the board and have a look at US Treasuries, because there were some marked moves in terms of the selling pressure, particularly at the long end when it comes to US Treasuries. Moves of 19 basis points higher on yields on the benchmark 10-year. A bit of change in fortunes today, a bit more stability in the bond markets. Yields down 4 basis points, 372 on the 2-year. Euro dollar getting a lift, up 0.5% at 109. And Brent oil prices have been under pressure, currently, though, up 1.2% in the session. Looking through, it seems, these additional threats on China of 50% from President Trump. And gold just below $3,000 per troy ounce, but gaining 0.6% for the first time in 4 sessions for the yellow metal. Now, the European Union has dropped a planned 50% retaliatory tariff on American whiskey. Several member states had pushed for whiskey to be excluded in an effort to spare European wine and champagne producers from facing 200% tariffs, threatened at least by President Trump. Joining me now for an exclusive conversation is Samuel Masse, president of the European Confederation of Independent Wine Growers. Samuel, thank you for taking the time. Your response then to the EU taking retaliatory tariffs targeting US whiskey off their list. Is this the right move from the EU? Does it spare you and your members further pain?
Going in the right direction. Since the beginning, we're asking to have a targeted and limited answer to the US tariff. So we have to be careful to avoid any trade war. And it could be a smart move at the point, currently going this direction. I think it's going to limit probably the impact that we can have. And it's going in the right direction, if I can say like that. Yeah.
You represent about 200,000 independent winemakers across the EU. What has their response been, Samuel, to the 20% tariffs that are very likely to be put in place as of April the 9th? As of tomorrow, those 20% tariffs will kick into gear. What is the impact? What has the response been from your members?
Oh, that's a huge impact. I mean, what we fear the most is the impact that we will have directly in our farm. You know, we are represented small farmers mostly. Represented and family-owned businesses. So that is something that we expect. In France, for example, I remember we already had tariff regarding the conflict between Airbus and Boeing with 25% taxes. The impact was huge with 100 million losses at national level. So it was huge. And now we see that spread all across Europe. So indeed, this will have a huge impact. And I think what we fear the most is the thing that we will have to diminish our margins. So this will also have an impact. So yeah, definitely, we have to make sure that this does not happen to us directly.
Yeah. OK, so a squeeze on margins. I mean, we see the animus that President Trump has towards the EU. He says the EU was set up to quote unquote screw the US. We know that factually that is not correct. Nonetheless, we know how strongly he feels about the European Union. So there is an expectation. There has to be an assumption that those 20% tariffs or a level around that will be kept in place for some time. What does that mean? How do you quantify that in terms of the damage on your sector, in terms of job losses and potentially business closures?
We think it's going to be billions, because if you look across Europe, for example, if you look at only my country, 24.5% of all the exports goes to the US if you add wine and spirits, which is huge. And if you accumulate with other Europe, it's huge. So that's something that we will have to bear in mind. That is going to be very hard. But the thing is not only currently the trade war that is affecting us, is the wine consumption, is the climate change. So all of this, adds it as a huge impact and puts a lot of pressure in each small winery that we have, So definitely it's going to be something that we did not need it at the time.
What steps are your members taking, Samuel, to mitigate some of these impacts?
Yeah.
Are they looking at higher prices? Are they looking at reducing jobs? What are they doing right now to try and offset some of these pressures?
I think all of it, I will say. What we are looking for first is to talk with our already existing importers in the US, how we can manage all of this. Currently, everything is imposed, so we have to wait a little bit, and them also are waiting a little bit to see what we are going to happen. We can find new markets, but again, the US is like the UK. It's a mature market that the consumer already knows how wine is, which could not be the same if you look at India or as a market. We will have to invest a lot in order to be, known as a product. So that's something that is going to be in the future. And what also the president of the Commission said, Ursula von der Leyen, last week during her address to the Parliament, she said we have to unleash the single market. So maybe also we have to invest in the EU market. So that could be a thing. But again, the US is very important for us. It's a key market, and we have to make sure that in the future it stayed as an important market. Yeah, definitely. But for us, it's going to be hard, and we'll go ahead. Good.
Now, in your conversations with those US importers, I understand there's a lot of uncertainty. What are those conversations looking like? Are they asking you to absorb most of the tariff increase? Are they prepared to take some of it? How is that conversation playing out?
So it depends on each winemakers. Sometimes it's hard to shrink this, but the thing is, it's going to be 50-50 at the end of the day, and it was already the case in 2019 for us. I think it's going to be the same this time. So that's the discussion we are going on right now. And again, in a margin that is getting smaller every day, it's not hard. It's not very easy for us to continue this way. Yeah. And I'm not sure it's going to be also good for the US consumer.
Sure. What support are you hoping to get from the EU? Are you lobbying the EU to support the industry, and what kind of support would you be looking for?
Definitely. We are asking to have a safety net, a financial safety net, in order to face all of this, not only for a sector. Every sector in the EU should be, having some proportionate answer financially to face that. Also to help us to have, promotion all across the world in order to help to have our wine everywhere. And also, at the end of the day, it will be great also to have an answer in the EU single market to find ways to also sell our products. So, yeah, that's all the things that we are asking. But I think the most important right now, it's what we started, our discussion, is to find a solution with the US. And I think that will be the key answer for now.
OK, Samuel Masse, president of the European Confederation of Independent Winegrowers, on the potential impact across that industry and what that industry needs to see from the EU and in those negotiations. Samuel, thank you for taking the time. Now, Citadel founder Ken Griffin has called President Donald Trump's latest tariffs, quote, a huge policy mistake. He joins a chorus of Wall Street executives criticising the levies, including BlackRock CEO Larry Fink.
Most CEOs I talk to would say we are probably in a recession right now.
Right now.
A couple of airline CEOs told me. One CEO specifically said, the airline industry is like a proverbial bird in a coal mine, canary in the coal mine, and I was told that the canary is sick.
Well, Charlie Wells has been tracking some of the corporate reactions and joins us now. Charlie, is the American C-suite turning on Trump?
Tom, in the past
24 hours, we have heard some very striking shifts in tone here. There'd been a kind of tactical silence over the past few months since Trump's inauguration, and we have seen some of the biggest names on Wall Street come out fighting against these tariff policies. So we just heard Fink right there, but we've also got Ken Griffin, and he is really notable. He's the founder of Citadel, of course, but he's also a Republican mega donor who in that prior presidential cycle donated some $100 million to pro-Republican political action committees. He said in an event at the University of Miami that this tariff policy was a mistake. He said that it was a tax on the middle class. It was wrong to tell middle-class Americans that prices for vacuum cleaners, groceries could go up 20, 30, 40%. And striking here, he called on members of that audience to contact Donald Trump and tell him to step back from this policy. So those are some fighting words. We also, of course, heard yesterday from Jamie Dimon. So in that span of just about 24 hours, a really sharp shift towards criticism of this Trump policy.
It just seems we're going to hear more of this, doesn't it, in the hours and days ahead. Is there any evidence that this kind of pushback from corporate C-suite executives in the US cuts through with President Trump?
I mean, Tom, that's kind of the question of the moment. I think in Trump 1.0, this may have had more of an effect, right? During that first administration, he was really focused on what Wall Street was doing. We're seeing a shift, at least a seeming shift in priorities here, where Trump has been downplaying what's been happening in the market. We heard the Treasury Secretary saying that what's been going on is more of a MAG 7 problem than a MAGA problem. But these are incredibly influential voices. And I think it's one thing to hear from the Democratic side. It's one thing to hear from, CEOs. When you think about Griffin, when you think about the amount of money that he donated to Republicans, this is significant because he's really kind of bringing a new level of criticism here.
Okay, Charlie Wells, excellent breakdown of what we've been hearing from some of these executives in terms of the pushback and the lack of comfort around the Trump tariff policy, and we'll see if that leads to any changes at all. Charlie, thank you for the update on that front. Coming up, uncertainty, of course, continuing to grip the markets on President Trump's tariff agenda. We're going to discuss that with Emmanuel, the head of European equity strategy at Barclays, and get his view on how to position amid the uncertainty and volatility. That's coming up. This is Bloomberg. Welcome back to Bloomberg Daybreak Europe. Let's check in on the futures picture then. It is a slightly brighter picture, but for how long? And that is the question. European futures pointing to gains of 2.3% after falling, around 4.3%, 4.4% by the end of the close yesterday. An incredibly volatile session in the US with those intraday moves, of course, on the S&P 500. Volatility spiking. S&P futures now pointing to gains of 1.1%. NASDAQ 100 futures also looking to add 165 points. But for how long? That is the question. Is this a dead cat bounce or more of a sustained turnaround in these markets? Let's bring in Emmanuel, head of European equity strategy and managing director at Barclays. Emmanuel, thank you so much for taking the time. I know on a very, very busy moment for you and the team. What do you make of today's moves in the markets? Futures pointing higher. Is this a sign that maybe the markets are finding a bottom?
Yeah, morning, Tom. Well, it's a good thing to see some green on the screen this morning. Look, I think the market is very oversold. I mean, things have come down 10-15% in a matter of days. So there is maybe a sense of hope that we are getting to a point where the pressure is so high on Trump that he has to open door to negotiation or give a bit of time for these tariffs to be implemented, right? So, to see some bottoming out from oversold level makes completely sense. We might see a technical rebound if indeed we find out the flexibility from Trump. But I think in the grand scheme of things, this market route won't stop until Trump backs off. I mean, I think everybody agrees that this is a massive mistake. As long as Trump is somewhat entrenched on the tariff view, I don't think the market will be able to find a sustained bottom. So for now, the question is whether there is room for negotiation. If there is, I think we can maybe think about some short-term upside from these oversold levels.
How binary, then, is this moment, Emmanuel? If you see a President Trump who is willing to negotiate, willing to think about a reprieve, versus a President Trump who continues to double down, is this a binary moment that rests on that calculus for these markets?
Look, I think we are midway between market, pricing, kind of correction and a recession, right? So if you have a recession, which could be the end game in case of those tariffs being implemented, the market can be down another 10, 15, maybe 20%. The typical peak to trough move we had in past recession was about 30 to 35%. So there's still a long way to go for the market to fully price a recession. Now, on the other hand, we are looking, as I said earlier, quite oversold. And if Trump is backing off early on to prevent this recession, we can go back up. And we've been coming out with a range for our market, for our index target on the stock 600 between 550 in a case of a very, very quick resolution and 390 in a case of more severe downturn and impact on the economy. So we can go up 10%, but down for another 10% from here, right? I still believe there's a lot of damage being done. So even though the market might come back up on any negotiation or deal headline, I do believe that there's so much damage to be done with the credibility of this administration and the lingering uncertainty that market won't get back up to the previous high, at least in a straight line.
So that range of 550 to 390, I mean, you talked about how wide that range is. We ended the session on 474 across the European stock 600 yesterday. So that 390 level on the downside, Emmanuel, that is the recession call, is it?
Yeah, to put it very simply, it's not very scientific because putting numbers on this is very hard. I mean, there is no precedent, to be clear, for this situation. In a normal crisis, pretty much the governments and the central banks trend to rush to bail out the market. And now, for the first time, we have the U.S. administration somewhat opposing the market. So there is no put from Trump right now. And without the put being triggered, yes, I think we can go down, and there is nothing to stop the market to price a recession. It's all sentiment driven right now. We have not yet seen the data reflecting this massive uncertainty, and we have not seen the data reflecting the tariff impact on investment and consumption, right? So if you look at earnings expectation by consensus, they're looking for 12% growth in the US and 6% growth in Europe. So the market has derated, but on still very, very high earning expectations. I think the downside is very much from here, market increasingly pricing a recession, which will happen without some pivot from Trump, basically.
What draws the central banks, and specifically the Fed, from the sidelines, do you think?
Well, simply the inflationary impact of this tariff. So I think if the financial stability is being threatened, I suspect the Fed and maybe other central banks will have to intervene. But right now, we are seeing signs of stress in the market, definitely. But I think there is enough question mark on the inflationary impact of this Trump policy for the Fed to sit on the side and see what happens. So, of course, if they have to, the Fed will intervene. But again, the number one issue to me is Trump and the loss of credibility he has with markets. So if he doesn't pivot quickly, the Fed can do whatever they want. But I don't think the underlying issue for this market will be resolved.
Longer term, what does Europe look like as US exceptionalism is challenged?
Well, I think the end of US exceptionalism could be Europe's chance to shine. And firstly, Europe is where now stimulus will happen. We think this German fiscal advisory guy is a big thing. It won't help the economy for the next couple of months. But on a multi-year horizon, this is a big thing. Germany is spending 10% of GDP to support their economy. So what Trump is doing is forcing a very unexpected and significant response from Germany, which could have a big impact on domestic demand. And at the same time, I think the cheapness of the European market might help it to weather the storm, right? So there was so much money going to the US over the past 10, 15 years, so much capital playing there that if now the US has a more anti-market or anti-business policy, I think some of this capital repatriation might help rest of the world equities and Europe in particular.
Emmanuel, before we let you go, you are overweight the UK, FTSE 100. Talk us through the rationale behind that view.
Well, look, this is not so much about the UK economy. To be clear, it's more about a market which can do the job to give us a bit of hedge against this uncertain time. I mean, the UK market is obviously a bit of defensive index, so it will give us some hedge on the way down. But given the commodity and the energy and the materials weight as well, I think the index could have interesting optionality to the upside if the market rebounds. So it's a bit of a win-win stagflation, uncertainty hedge in this environment, but with a tilt to the upside, given the commodity weight and given the valuations, the high yield you get on the index, pretty much 7% dividend yield. The carry is pretty interesting on this. So that's a tactical trade. But look, for now, that's something which can give us a bit of optionality, both on the way down and on the way up.
OK, tactical trade, FTSE 100 at a time that has, and I'm quoting from Emmanuel, no precedent. Emmanuel, head of European Equity Strategy and Managing Director at Barclays. Really smart insights. We appreciate your time, of course, as we think and look ahead to a slightly brighter picture. At least that is what the futures are pointing to for Europe. And a note, check out the Markets Daily newsletter for what is happening in stocks, bonds, currencies and commodities right now. This is the time when you want to be signing up at Bloomberg.com/newsletters. This is Bloomberg. OK, welcome back, everyone. Take a breath. The futures are pointing higher for Europe and the US. But for how long? What a wild session stateside yesterday. The S&P is still near that bear market territory, still close to that 20% drop from its most recent high, of course. It was an incredibly choppy session and volatility was extreme. But again, US futures currently pointing to modest gains. Let's flip the board and have a look at the volatility question then. For the S&P 500, the intraday moves, we have not seen spikes like this and volatility like this, the pronouncement in terms of the intraday moves, since you have to go all the way back to 2020 to see that kind of volatility. And a lot of that, of course, sparked by the rumours around tariffs and how the Trump administration was thinking about any kind of reprieve. Some of those rumours, of course, being nixed as well. Let's flip the board and have a look at the Fed pricing, because that was also choppy in the session. We went from 5 cuts being priced in back to 3. Now you're closer to 4 at 96 basis points or thereabouts. So markets still trying to understand how the Fed is going to react to this. Some Fed officials, including Goolsbee, really putting the lens on the inflation risks around the Trump tariff policy. And for now, of course, the Fed remains on the sidelines. The next cut, not the first cut, but the next cut expected and fully priced for the month of June. Again, markets now pricing in around 96 basis points, so close to 4 cuts being priced in, but it chopped from 3 to 5 yesterday. Later today, we're going to speak with the former US Treasury Secretary Larry Summers to get his take on tariffs and market volatility. Coming up later as well, we're going to speak with Hungary's foreign minister. Hungary, of course, really crucial in terms of how Europe responds, not just on the tariff front, but on defence spending and question marks about Ukraine and Russia as well. Do not miss that interview on The Pulse at 9:30 a.m. UK time. We'll leave you with a check on the futures on a day when maybe, just maybe, the markets are finding something of a bottom, or if there's a brief stay of execution. European futures pointing higher by 2.6% after dropping more than 4% yesterday. The opening trade is up next. This is Bloomberg.